Should you buy a house right now, or is it smarter to wait? This is the question on everyone's mind as mortgage rates and home prices continue to shift in 2026. Today, we'll break down the real numbers, the real data, and the real impact on your wallet. Before you make any decisions, let's look at what's really happening in the market and what it means for you as a potential homebuyer. Stay with me as we uncover the truth behind the headlines and help you make the most informed choice possible. Let's start with a number that might surprise you. If you borrow $300,000 at today's mortgage rate, you'll pay $396,832 in interest alone over the life of the loan. That's not even counting the price of the house itself. Essentially, you're paying for the house almost twice. This is the reality for buyers in 2026, and it's why so many people are searching for answers about mortgage rates and timing their purchase. The cost of borrowing has never felt more real. Every day, thousands of people are searching for the current mortgage rates, trying to figure out if now is the right time to buy. The uncertainty is real and the stakes are high. With so much conflicting advice out there, it's easy to feel overwhelmed. But today, we're cutting through the noise with real numbers and up-to-date data so you can see exactly where things stand and what your options really are. Before we dive deeper, there's a common misunderstanding about mortgages that trips up a lot of buyers. Most people focus only on the interest rate percentage, but don't realize how much that number impacts their monthly payment and total cost over time. Once you see the real effect, it's impossible to ignore. Let's break it down with a simple example that makes the numbers clear. Imagine two friends, Jake and Sarah. They're the same age, have the same income and the same credit score. Both are buying a $400,000 house with 20% down, borrowing $320,000. The only difference, Jake bought in January 2021 at a 2.65% rate, while Sarah is buying now in July 2026 at 6.65%. Their situations are nearly identical, except for the timing of their purchase. Jake's monthly payment is $1,291, while Sarah's is $2,062. That's a $771 difference every single month for the exact same house and loan amount. Over 30 years, Sarah will pay $277,560 more than Jake, just because of when she bought. Timing can make a massive difference in your financial future, and this example shows just how much. But it doesn't stop there. Sarah also paid more for the house itself, because home prices have risen 50% since 2020. So not only is she paying a higher interest rate, but she's also paying a higher price. This double hit makes buying in 2026 especially challenging for new buyers. It's a tough reality, but understanding it is the first step to making a smart decision. As of July 24, 2026, the average 30-year fixed mortgage rate is 6.65%. Freddie Mac reports 6.58%, and Forbes just noted a one-month high of 6.7%. Rates are sitting between 6.55% and 6.7% right now, and they've gone up this week, not down. These numbers are shaping the decisions of buyers everywhere. Why did mortgage rates go up? It's all connected. The recent US-Iran conflict pushed oil prices higher, which led to higher inflation. Higher inflation means the Federal Reserve stays cautious, and that keeps mortgage rates elevated. Every part of the economy is linked, and global events can impact your home buying costs. Here's a historical fact. Since 1971, the all-time median mortgage rate has been 7.23%. That means today's 6.65% rate is actually below the historical average. But it doesn't feel that way, especially if you remember the ultra-low rates of just a few years ago. Context matters when making big financial decisions. Why does 6.65% feel so high? In 2021, rates were just 2.65%. In 2023, they peaked near 8%. We've gone from historic lows to near historic highs in just a couple of years. For many buyers, especially younger ones, 3% and 4% rates are all they've ever known. That's why today's rates feel so tough. Let's look at the numbers again. On a $300,000 loan at 6.65% over 30 years, you'll pay $396,832 in interest alone. That means you borrow $300,000 but pay back nearly $700,000. The bank collects almost $400,000 just for lending you the money. It's a huge cost that's easy to overlook if you only focus on the monthly payment. Now compare that to a 15-year mortgage. The current rate is 5.84%. On the same $300,000 loan, you'd pay $150,477 in interest over 15 years. That's a difference of $246,355 compared to the 30-year loan. The monthly payment is higher, but you save nearly $250,000 and own your home much sooner. Most buyers default to the 30-year mortgage because the monthly payment is lower, but banks don't always highlight how much extra you'll pay in interest over time. Understanding the true cost of your loan can help you make a smarter choice and potentially save a huge amount of money. Let's break down the full cost of buying a home in 2026. Say you find a house listed at $400,000 and save up 20% for the down payment. That's $80,000. But you're not done yet. There are more costs to consider before you're truly ready to buy. On that $400,000 home, your mortgage payment on $320,000 at 6.65% is $2,062 per month. Add property tax, about $350 per month, home insurance, around $150, and maintenance, about $333 per month. Your total real monthly cost is $2,895, and that's before any HOA fees or surprise repairs. Don't forget the unexpected. Two-thirds of buyers face surprise costs after moving in, like a broken water heater or a roof that needs repairs. These expenses can add up quickly, so it's important to budget for the unexpected when planning your home purchase. Financial experts recommend that your total housing cost should not exceed 28% to 30% of your gross monthly income. For a $400,000 home with $2,895 in monthly costs, you need to earn at least $9,650 per month, or about $115,800 per year, to stay within the safe limit. That's a big ask for many buyers. Right now, the median U.S. household income is $80,610. That's a $35,000 gap from what's needed to safely afford a $400,000 home. This gap explains why so many people feel priced out of the market, even if they're earning a decent salary. Here's the first shocking stat. The average age of a first-time homebuyer in America is now 40 years old. In the 1980s, it was the late 20s. Just 5 years ago, it was 33. People are being priced out for over a decade of their prime earning years, and that has a big impact on their long-term wealth. Buying at 40 instead of 30 costs the average person about $150,000 in missed equity. That's because, for 10 years, you're building someone else's wealth through rent instead of your own through a mortgage. The timing of your purchase can have a huge effect on your financial future. Stat number 2. Right now, 30% of competing buyers are paying all cash. That means no mortgage, no rate concerns. They're recycling equity from homes they already own. If you're buying with a mortgage, you're competing with buyers who don't even need a bank. Stat number 3. The U.S. housing shortage is 4.7 million units. That means there are 4.7 million fewer homes available than people need. This shortage keeps home prices high, even as rates go up and buyers pull back. Prices aren't dropping because there simply aren't enough homes. This isn't a normal market. It's structurally broken, with high prices, high rates, and not enough homes. Understanding this reality is crucial for anyone thinking about buying a house in 2026. It changes how you should approach your decision and what you should expect. Now let's get to the question everyone wants answered. Should you buy now or wait? Let's look at both sides, using real data so you can make the best decision for your situation. The Federal Reserve has already cut rates 3 times, from 5.25% to 3.75%. Economists expect 1 or 2 more cuts before the end of 2026. If that happens, mortgage rates could drop from 6.65% to around 5%, 6% by early 2027. On a $320,000 loan, dropping from 6.65% to 5.75% saves you $178 per month, or $64,080 over 30 years. If your credit needs work or your down payment isn't ready, waiting could make financial sense. But here's the problem with waiting. You're not the only one. Millions are sitting on the sidelines waiting for rates to drop. When they do, demand will explode, competition will spike, and home prices could go even higher. You might save on the rate but end up paying more for the house. The math often comes out the same, or worse. There's a saying in real estate: marry the house, date the rate. That means find the right home for you and buy it, even if the rate isn't perfect. The rate is temporary. You can refinance when rates drop. But the right house in the right location is harder to find and could get more expensive if you wait. Refinancing lets you lower your rate on the home you already own. Freddie Mac's data shows that getting just one additional mortgage rate quote saves the average borrower $600 over the life of the loan. Getting 3 quotes can save up to $1,200. Most people take the first rate they're offered, but shopping around can put real money back in your pocket. Here's your action plan for 2026. Step 1. Run your real numbers. Don't just look at the listing price or a basic mortgage calculator. Add up the full monthly cost, mortgage, taxes, insurance, and maintenance. Make sure it stays under 30% of your gross monthly income. That's your true budget. Step 2. Your credit score is worth tens of thousands of dollars. The difference between a 760 and a 680 credit score can mean a 0.5% to 1% difference in your interest rate. On a $320,000 loan, that's $100 to $200 less per month, or up to $72,000 over 30 years. If your score is below 740, spend 6 to 12 months building it up. It's worth the effort. Step 3. Save more than just the down payment. Closing costs run 2% to 5% of the purchase price. On a $400,000 home, that's $8,000 to $20,000 extra. Plus, have 3 to 6 months of mortgage payments saved as an emergency reserve. Buying with zero cash left over is a recipe for financial stress. Step 4. Get at least 3 mortgage quotes from different types of lenders: your bank, an online lender, and a credit union. The difference between the best and worst rate for the same buyer can be 0.5% or more. On a 30-year loan, that's a life-changing amount of money. Step 5. Seriously consider the 15-year mortgage if your income allows it. The rate is lower, 5.84% versus 6.65%. You'll pay $150,000 in interest instead of $396,000, and you'll own your home 15 years sooner. The monthly payment is higher, but the wealth building is much faster. Here's the bottom line. The 30-year mortgage rate today is 6.65%. Home prices are 50% higher than in 2020, and incomes have only grown 29%. There's a housing shortage of 4.7 million units, and the average first-time buyer is now 40 years old. The typical buyer in 2026 is spending 40% of their income on housing, well above the safe limit. So should you buy or wait? If your credit is above 740, your down payment is ready, your full monthly housing cost stays under 30% of your income, and you found the right house, buy. Marry the house, date the rate, and refinance when rates drop. If any of those boxes aren't checked, wait and prepare. If you're not financially ready, the best move is to wait. Build your credit, save your down payment, and make sure you're in a strong position before entering the market. The housing market will still be there, and you'll be much better prepared to succeed when the time is right. The worst decision in real estate isn't buying at the wrong time. It's buying when you're not financially ready. Take the time to prepare, and you'll avoid the stress and financial strain that comes from rushing into a purchase before you're truly ready. To sum up, mortgage rates are high, home prices are higher, and the market is more competitive than ever. But with the right preparation and strategy, you can still make a smart move. Focus on your financial readiness, understand the true costs, and don't rush into a decision. The right home at the right time is still possible. The housing market will continue to evolve, and rates may change again in the coming months. Stay informed, keep your finances in order, and be ready to act when the right opportunity comes. Patience and preparation will put you in the best position for success. Now that you know the facts, take action. Review your finances, check your credit, and start building your savings. Whether you're buying now or later, these steps will help you make the best possible decision for your future. Keep up with the latest market trends and mortgage news. The more you know, the better prepared you'll be to navigate the ups and downs of the housing market. Knowledge is your best tool for making smart decisions. Buying a home is one of the biggest decisions you'll ever make. Take your time, do your homework, and don't let pressure from the market or others rush you. The right home is out there, and with careful planning, you'll be ready when the time comes. That's it for today's breakdown of the 2026 mortgage market. I hope this gave you clarity and confidence as you consider your next steps. Stay tuned for more insights and tips to help you navigate the world of real estate and personal finance. Thanks for watching. Remember, your financial future is in your hands. Make smart choices, stay informed, and I'll see you in the next one. Peace.